Hi everyone, welcome to Foxon Media Digital. My name's Amy and today I'm joined by Thomas Becket, who's Chief Investment Officer at Canaccord Genuity Wealth Management. So welcome Tom, it's great to have you on the channel.
Well, thanks for having me, Amy. Thank you.
Yeah, of course, you're speaking at the Summit for Wealth Management on the 9th of May in London. So we wanted to catch up with you ahead of the event just to find out a little bit more about you and what you're focusing on. So just to get started, could you introduce us to yourself and tell us a little bit about your career background and what you focus on in your role?
Yeah, absolutely. You know my name already. I've done the same job really for the last 19 years. And it's been a dubious pleasure working in wealth management over that period because it's been a lot of very hard work, but also it's been very, very interesting. My role in itself hasn't necessarily changed a huge deal. And I recently joined Canaccord Genuity Wealth Management from Hunt Wealth because they bought our business. But my job remains constant from where it was before, which is focusing in on multi-asset investing. That's genuinely multi-asset, not multi-asset, but actually just a real equity portfolio, and multi-manager selection. And everything we do here has an inflation plus background. So we believe in the power of real returns, which I'm sure we'll get into the discussion today, has become much more difficult recently.
Yeah, let's expand more on that because obviously tell us a little bit more about your investment strategy and how inflation has affected you in the past 12 months and where we are now.
It's affected all of us in many different ways, whether it's as investors or someone running a business, or someone who just has the deep misfortune of going to Sainsbury's or your supermarket of choice and going and paying for stuff. As we all know, life has become much more expensive. It's become a lot less certain, and from an investment perspective, inflation is what kryptonite is to Superman to an investor. It's the enemy. And causes a lot of problems. And it's notable that, I've done really the same thing for the last 19 years, managing these multi-asset strategies. And inflation plus benchmarks were always quite hard to meet, but achievable. And what we've really seen in the last year is giving back an awful lot of that relative outperformance you've had over inflation in the last 12 months. And what we hope is this isn't the tell for the future, rather it's an issue that we're dealing with in the past. But let's put it in very simple terms. In the last year, all asset prices have fallen. They've done the opposite of what a Vanguard or someone who really believes in diversification might tell you. And at the same time, inflation's gone up. So in very simple terms, it's been a really difficult situation. Now, potentially something has changed with regards to both inflation and asset markets. And I'll put that in integrated context of the real client experience in a minute. But if you think about it, the worst of the issues we saw, particularly as UK investors, happened between January and the end of September. Thereafterwards, any simple balanced portfolio for a UK investor probably was up 3-ish% at the end of last year, and it's probably up another 3% at the start of this year. We're recording this towards the end of January, but that's a recovery in itself already. And notably, putting it out into the real client experience, as well as having the pleasure of speaking at things like your conference, I go out and see a lot of clients, I see a lot of advisors. When I went out in October of last year, I was told how clever the advisors and the investment consultants and the clients were because they had a lot of money on the sidelines and they hadn't invested. Now, noticeably, and we know this happens, the pendulum has swung from the fear of losing money and the fear of missing out quite quickly. And now, having seen what's still a relatively nascent recovery for asset prices, people once again focusing in on where the investment opportunities might mean. So it is a very different situation now to where we perhaps were 4 months ago, Amy.
Yeah, absolutely. Things change very quickly, don't they? So are there any significant lessons learned when it comes to creating resilient portfolios? Has this changed your attitude to asset allocation? Or do you think it was, as you say, just a phase over 12 months and now we're in recovery?
Has it taught any lessons? Every day is a new school day if you work in investment markets, and lessons are always painful. I think it's important to sort of reset and reshape how you think about investments and how in our industry you look to sell yourselves in a suitable manner to external parties. And it's notable that whatever the situation there is always a way to speak to clients and impress upon them the job that you've done with portfolios. So in the last year, for example, if you take 2022 as a whole, it might sound like an appalling loss to some people, but a balanced portfolio management was roughly down around 7%. And then you point towards, well, people say inflation was up 7-ish for the year as a whole, in your down 7, and you say that's absolutely right. But an inflation plus benchmark should be over a long-term aspirational period. 7, 10 years. In the short run, it's not necessarily changing the story, it's just re-emphasising what you've done in the circumstances you've been in. And again, to say that you're down 7 when another balanced portfolio went down 15 or 16 and you missed out the worst of the problems you've seen in financial markets, it's a lot of the lessons learned the last year have been about educating your clients and making sure everyone knows exactly what it is you're trying to do. I think it's also shown the importance of ignoring the recency bias that our investment industry operates with. And let's put that into context of how much things might have changed in the last year from what we saw in the previous decade. And I've been boring the people who invest with us for a good few years now about the concept of the turbulent 20s. And in very simple terms, that was really just that this decade was going to be much more difficult than the 2010s, because it might not have felt like it, but the last decade was A, an easy time to be a wealth manager, and B, a golden age for anyone to be an investor. And why? Because anything from expensive footballers all the way through to government bonds all just went up in price. And that kind of makes sense because it was a predictable period. Inflation was low but positive, economic growth was low but positive, interest rates were low but positive. The central bankers got out of bed every single morning and they wanted to make our clients richer. So asset market returns were consistently high. As we sit here today, all 4 of those big pillars have at least changed. Actually, a lot of them changed quite a great degree. We've got a lot more uncertainty around all those factors, but also put it into the context of beneath the bonnet trades in markets. The last decade, people attending your conference might want to hear this, but it's true. People could have fired us, just gone to the Hargreaves Lansdown website and just bought the Vanguard lifestyle products. And people will still do that because actually it's a cheap, efficient way of getting access to exposure to investments. But that was almost the trade for the last decade because the big got bigger in financial markets. The US market consistently outperformed. There was a lot of predictability. Growth stocks just continually did well against other markets. And again, this was one of those predictable things you could hang your hat on. Well, the last year, it's potential that all of those things have changed. The US has started to underperform. Value has outperformed growth. If you think about it from the perspective of other markets around the world, you're starting to see a bit more of a renaissance in other investment markets. This is one of the reasons why I'm very excited about the potential. And I go out and see clients and advisors now, and not just say it because it's a positive message, to try and encourage people to stay invested, but you say, actually, this is exactly the sort of environment going forwards when the wealth management industry should be doing well. Because actually the whole concept of the last 10 years, not really needing a wealth manager, I think is behind us. Now we become much more relevant because the market trends and trades are changing. And there's a different dynamic that we can pick up. And I think it should be a renaissance of wealth management. And dare I say it, you've heard it before, actually a very good period ahead for active investment management too.
Yeah, very well said. Those are good points there about the change in, need for wealth management. I think we saw a lot of those retail investors popping up in the pandemic, having a go at managing their portfolios themselves, and
absolutely
been through so much disruption.
The game has changed. There's no doubt about that.
So tell us a little bit more about your client segments that you serve then. Have their demands changed in the past 10 years with this shift, as there's been more of a need for wealth management? What are they wanting from their services? What are their priorities?
Yeah, well, we've always really done the same thing. And I think it's important in wealth management not to try and offer too many things to too many people. And there are very big companies out there in the UK who've been very successful doing that. But in reality, if I think about why clients have come to the business that I run and the business that I oversee from an investment perspective, they come to us for multi-asset, multi-manager investing, in particular those portfolios which are a bit more cautious and a bit more balanced. And this probably answers your question a little bit, because if you think about coming out of 2008 to 2009, the biggest selling sector thereafter was the IMA cautious managed sector, because people had hindsight bias. No one really wanted to take too much investment risk. Actually, at the time, you did want to take a lot of investment risk, but people were affected by hindsight bias. And now, interestingly, once again, people are saying, well, I want to invest, but now I want to have something which is a bit more cautious and balanced, and because I'm quite uncertain about the future. So I think necessarily the client needs haven't changed, but I think people wanting to focus in once again on predictability in an uncertain environment has certainly come to the fore. And one of the reasons why I think this is a particularly opportune time to be discussing such subjects is because of the radical shift that we've seen in fixed income markets. Now, our balanced portfolio, which a balanced portfolio is one of those terms of wealth management that no one really ever understands. And I'm amazed the regulator still allows the term balance to be used, because you can have one balanced portfolio of 40 in equities, one in 60 and one in 80. I mean, who knows which one of those is more balanced, but ours used to have as much in fixed income as we did in equities. And obviously, for quite a lot of the last 13 years, since governments completely distorted financial markets, and in particular bond markets, fixed interest investment has been less relevant. But as we sit here today, and the pains and the problems we saw in 2022, that's once again brought fixed income markets way back into relevance. I mean, I would argue, for those of us who've invested for a long time watching this, we've basically gone back to where we were before the financial crisis, with fixed income being able to provide a steady and sensible return and give you some ballast in your portfolios, whereas previously, for the last 13 years, it's been much less relevant because bond yields have been manipulated so low. And as we sit here today, one of the things that people are really interested in is that whole concept of a fixed interest portfolio, really for the first time in 13 years. And I think this is one of the things which the wealth management community can do better than individual retail investors, and brings us once again into relevance. So another thing that people are looking towards is exactly that sort of investment portfolio as well. So I think a greater balance on cautious and genuinely balanced portfolios, and a focus in on fixed interest investments, really for the first time in quite a long time.
Yeah, it makes a lot of sense. Even in other markets as well, outside of the financial markets, you look at mortgage rates, there's so much interest in fixed rates as a whole because people are so scared by the variability, I think. So what is your outlook for the next 12 months? I know it's a really uncertain environment, but given where we are now, what do you think will happen in the next year?
Yeah, so I mean, I think it's important to put it into the context of the recent past to help shape the answer for the future. Now, in my view, the past is the past, it's not prologue, but it's important to know where we've come from and where we're going to. So if you don't mind, I'll just go back to the end of 2021, and I wouldn't have been very welcome at your conference, and I wasn't that welcome going out to pitch for new business, because my view was in 2021, both bonds and equities would lose money. Because I looked at the valuations of both and just said, well, they're wrong. And yeah, they're probably right for the 2010s, but they're not right for the turbulent 20s. Now, as we sit here today, after a year last year where both US bonds and US equities in dollar terms lost 15%, I think it's a much more nuanced situation now than it was beforehand. And actually, I'm finding good opportunities in both equity and bond markets this time. It's interesting, if you go back to the halfway point of last year, and certainly by the time we got to the end of September, people talk about the death of the balanced portfolio. That whole concept of the 60-40 equity bond portfolio, the passive investment, people saying it was dead. There was no point to it anymore. Actually, I think it's probably died and risen again. Once again, I would actually look at it and say, well, actually, there is the ability for a balanced portfolio to do the job it's supposed to do. 60% of your growth assets, 40% your dependability, those commas, not last year, of fixed income. And I think it's come back into relevance. As I sit here today, though, I would urge people to have 60 in fixed income and 40 in equities. I think what we're seeing right now is a mispricing in the fixed income markets on a medium-term view. Things can get worse before they get better, where you can once again put together a fixed interest portfolio and achieve a yield of 6%. Well, 6% strikes me as being better. It's very attractive by comparison to the 3% it would have been a year ago, that's for sure. So I would look to that, and I think that's really quite attractive, and have a lower weight, but some in equities. And the reason why, in answer to your question about the outlook, I think that what we're seeing now is more of a profitability issue than a solvency issue. What do I mean? I think the environment that we're in, going to stay in for a while, will be difficult for companies to keep on generating the sorts of wonderful profits growth that they did in the 2010s, which was, let's be honest about it, a corporate profits miracle. Mostly only because they didn't pay us enough money and the companies kept the profits themselves, which is a very smart thing to do. But that's now changing. And there is pressure from the labour market in the form of higher wages. So profits might not be fantastic going forward, even if markets have readjusted and reflect that more difficult profit outlook. But on the other side of the equation, the fixed interest side of things, yeah, I mean, I think it's going to be tough. There's no doubt about that. It'd be naive of me, irresponsible even, not to suggest that the outlook could be tough. And I think corporate defaults are going to rise. But how much is priced in? And how bad do you think it's going to get? And this is where it starts to get quite interesting, because let's not forget, and I'll save some of this for your conference, that fixed interest is a mathematical argument. What am I getting paid for investing in this bond at this price, for how long, and what are the chances of default? And for the first time in 13 years, really, that equation is very much in the investor's favour. And that's what starts to make me attracted to it. I mean, I think defaults will rise. I don't think they're going to become so bad to wipe out that 6% type yield you're going to get from a fixed interest portfolio. So my outlook is uncertain. It's confused in some ways. It's concerned. That's probably quite enough C's. But on the other side of that, well, let's do the C's actually. I'm confident that asset valuations are much more reflective of the outlook we're in and far more compensatory for the risks that we're taking. And that's why you can sit here in and amongst this uncertainty and speak to clients with some confidence about the future of their portfolios.
Yeah, thank you. Really some good insight there, and it makes a lot of sense. I think I'll ask you the same question in May, and we'll see where we are then.
May's a long time away. Quite a lot of things might change by then, Amy, but I'll try and stay consistent as possible. Thank you.
Well, exactly. That's the thing. You never know what could happen. We've had so many curveballs even in the past year, so I guess we'll just have to see where we are and see where the markets are. But I think that's all we've got time for now. So thanks so much, Tom, for shedding a bit of an insight into that.
Thank you.
And thanks everyone for watching. Don't forget to follow our YouTube channel for more content on the challenges and opportunities in asset management, wealth management, and ESG. And don't forget to give this interview a thumbs up and hit the subscribe button.